Hello, everyone. Today we're going to talk about how government spends and how government taxes, the basics that everyone needs to know. What's the impact of government spending and taxation on the economy? First of all, by way of introduction, we're just into 2021 now, and we've had this insane corona crisis over the last year, and there's been massive amounts of people unemployed and businesses shut down, and it would have been the Great Depression if we hadn't had our governments do massive amounts of spending, unprecedented amounts of spending to provide life support, literally, for households and businesses to get through this insane period of time. And everyone agrees that it would have been a Great Depression, an era of debt deflation if it hadn't been done. But now it was done, we've done all that spending. And so what are the implications of all that money printing and an increase in government debt? That's what we're going to talk about. So first of all, how does government do what it does? And what it does is when it pays for stuff, it pays simply by printing money and injecting it into the real economy. And how does it so-called fund those payments? By taxing, and this reduces the government deficit, just as when they pay for stuff, that increases the government deficit. And also they so-called funded by issuing bonds, government bonds, and they issue them either into the real economy or into the financial economy, which is when banks buy those bonds. And in that case, and when they issue bonds, there's no effect on the deficit. And so, but instead you have an increase in the government debt. And so now, when they spend, as I said, it injects money into the real economy. And when government taxes, that drains money out of the real economy. And issuing government bonds to banks drains money from the financial economy, from the banks. So now let's think about this further. So what is money? Money is purchasing power. And you need purchasing power in order to spend. And you need spending for there to be incomes. And you need incomes for economic growth. So what does that mean? It means you need money injected in order to stimulate growth. And you need to take money out in order to slow growth. So why not just let the money printer go brrr and just print infinite amounts of money? And obviously you can't do that. And the reason is because aggregate supply is limited. What do I mean by that? I mean that the capacity of the economy, the capacity of factories to produce stuff, to produce as much as people want to buy, it's limited. Once the capacity maxes out, then these factories won't be able to supply any more to fit this unlimited demand. There would be unlimited demand if everyone had millions of dollars. And so the factories, instead of producing more, they're just going to put up their prices because they see that everyone's got millions of dollars and they'll pay whatever price. And so that obviously what's happening then is crazy inflation. So inflation is the speed limit. When you see that there's inflation happening, that shows you that you've hit the limit and you can't be stimulating the economy anymore. It's the sign that the economy is running hot. And so when you see inflation, that is how you know that that's the situation when you need to slow down the stimulus, to stop stimulus and contract by increasing taxes or reducing spending. Now, the common question is, so how do we know how much the government can afford to spend? And so again, that's how you know. You know how much the government can afford to spend, that the government can afford it if it's not causing any inflation. So if there is inflation caused, that means the government is paying for that in the terms of a higher rate of inflation. Now, so if inflation rears its ugly head, then what do we do? Because we can't suddenly stop government spending or raise taxes, right? And so the answer to this is, first of all, see the next slide. And second of all, inflation doesn't happen so quickly. So just relax. And hyperinflation is not around the corner. Point C is that the Treasury What's their job? Their job is to be measuring the economic capacity of the various sectors of the economy, to know where there are bottlenecks and inflation risks. And so for every spending project, they should be able to forecast if it's going to cause inflation. So now let's talk a bit about the business cycle and automatic stabilizers. So automatic stabilizers is a technical term by economists, and let me explain what that is. So what it is, it's a way of automatically controlling the business cycle and inflation. So what happens? Taxes, it turns out that they have an automatic adjustment. So because there's taxes are related to incomes. So as incomes go up, taxes go up. And as incomes go down, taxes go down. So in other words, when the economy is strong, income taxes go up, and that slows the growth. And when the economy is weak, income taxes go down, and so the economy improves. And you can see that all in this lovely flow chart that just shows you exactly what I just said. And so in short, income taxes reduce the amplitude or the volatility of the cycle, of the business cycle, slowing the boom and also slowing the bust and helping recover from it. Now, a common question is if we need to target a balanced government budget, and the answer to this is a resounding no. Our population is growing, so that means GDP is growing, and also GDP is growing because of new technological developments and progress, which enhances productivity. And obviously we want to maximize GDP and maximize employment with low positive inflation. And so for this real GDP growth, you've got to have the money supply growing with it. Otherwise, you'll ultimately get deflation. And so for the money supply to grow, we must have a government deficit on average over time. So we need money in circulation in the real economy to be growing in line with the growth in real GDP. And by the way, note we must distinguish between the real economy and the financial economy. The financial economy is the stock market, real estate, banking, insurance, which is the FIRE sector. And we'll talk more on that next time. Now, another common question is what if interest rates spike up? Because people say that when the government borrows, then the lenders, who are the bond buyers, see that the government is desperate, and so they demand higher interest rates, pushing the interest rates up. But the reality, as we've seen for more than a decade, is that the government sets the interest rate. If they want to lower the interest rate, the central bank buys bonds, pushing up their prices, and the yields go down. And we've seen these low interest rates for the last decade, for example, with QE, quantitative easing policies. Now, another question is how will we pay back the government debt? And so when debt matures, the government prints the money and pays it out. And money is an IOU of the state. It's a piece of paper, just like the bond is. So when the debt is paid, it's just a swap of government bond paper for currency paper. So that has zero impact on the real economy and it costs nothing to do. And by the way, the interest payments on the debt arguably can have a stimulative or inflationary impact, but we'll talk about that more next time. And also, by the way, note that government bonds are essential actually for the economy. And the reason for this is that they are where we save our money to earn guaranteed returns with no risk. So they're a safe place to put our pension funds and our savings, and for insurance companies to put the premiums. And without them, there would be no risk-free place to invest our money. That would pay an interest rate, because obviously keeping money in the bank, you don't earn any interest, and ultimately that will erode away because of inflation. So you've got to have these government bonds that pay interest. And by the way, then often you hear the objection that, wait a sec, maybe we can't trust our government, but you've got to have a reality check then and remember that we're talking about people that live in advanced countries, not banana republics, people that have, countries that have proper rule of law, proper democratic elections. And in such countries, of course, there's lots of checks and balances on the system so that the government will never be allowed to default on their debts. Thanks for listening, everybody. Feedback welcome. And here's a few names that you can read about their stuff that talk about this stuff. Bye for now.